Hi guys, welcome back to What Would It Cost? We're here with our special guest today, Daniel Foch, who's a real estate broker.
What is it going to cost?
How much? Hi, my name's Nicholas Regina.
My name's Michael Sakuro.
And you're listening to
What Would It Cost?
Is that good?
This week's episode is brought to you by Charlie Burger's Wine Program. They're Canada's #1 subscription wine program. Every month for just over $100, the Charlie Burger Wine Program will deliver you 3 beautiful wines and accompany them with the story and background of each wine. These are wines that are not available at the LCBO and curated for a wonderful experience. Visit cbwineprogram.com and start a subscription or buy individual wines from the online store today. Well, thank you for coming out today, Daniel. I really appreciate it.
Yeah, thanks for having me.
So we'll get right into it. Tell us a bit about yourself and how you got into real estate.
I guess I'm one of those people who gets called out for riding their parents' coattails. I'm in a legacy business. My parents have been in real estate for like 30-something years. A little boutique team up in Keswick, Ontario, so about an hour north of Toronto, north end of the GTA. A lot of people say it's not in the GTA, but I like to say that or reiterate that it is. I don't decide the geography, but according to Wikipedia, it is in the Greater Toronto Area. And so,
he puts the realist in real estate.
Yeah. Sorry, guys. Well, it's like, I'll like post a listing and it's like, this is in the Greater Toronto Area, and you get like a bunch of Karens on Facebook because you use like a Facebook ads, right? And the Karens are like, this isn't in the Greater Toronto Area, and I'm like, no, it is. I post the Wikipedia like, sorry, the map, right? Sorry, it is. Like I didn't make the rules, but anyway. I'm from Keswick, born and raised there. I did an undergrad BCom in real estate at the University of Guelph. Did the kind of tour at a bunch of commercial real estate shops in Toronto. I worked for CBRE. I worked for a REIT. I worked in municipal government. Like what most people would do on a commercial real estate career trajectory. And then I got too good at the entertainment side of the commercial real estate industry. And so I moved out of the city and, actually I never really lived there, but I decided not to move to the city and started just selling small cap stuff with my family business. So my mom sells residential real estate, my dad sells commercial real estate, and I kind of pick up the slack in the middle there. When COVID started, I realized that it was pushing a lot of demand outside of the city of Toronto. Yeah. It was kind of like unheard of before then. I was. And then I started documenting what was happening there, right? And the media started getting attention to kind of what was happening there. I was creating maps, a lot of different data visuals on the impact of COVID on the suburban real estate economy. And now, being, I guess, Q2 of 2022, we're seeing that kind of unwinding, right? A lot of that demand going back to the core city of Toronto. Suburbs prices are coming down. Condo prices are probably the only asset in the market that's moving up right now. So the past 2 years have been really good for me, and I've sort of almost established a little bit of a weird foothold in the Toronto, house fluencer space, having these dialogues around what's happening in the suburbs. I think I was probably one of the people who is documenting that most in the suburbs. Most of the guys, like the Bay Street Finance type real estate broker pivot guys, like the gentleman you just had on, right? Like they're nice suits and well put together. They're all in the city, right? The guys who are putting together financial analysis on the real estate market. And so they're what the suburbs are kind of left out. Right. So that's been my thing. It's documenting. Very fascinated with the role that suburbs play in price and volume in the Greater Toronto Area.
Very cool. So the last couple of years must have been really exciting for that.
Yeah, they were. They have been. Yeah, I mean, and now probably more than ever, right? Like I think that seeing how when that pendulum swing happens as we start to see the urban areas reopening, I think. And the market finally settles into whatever the new normal is going to look like, right? You always hear about this new normal thing. It's like, are we going to have a hybrid work environment? Are people going to be mostly living in the suburbs? Are the cities changed forever, right? Like, I think the cool part about the real estate market right now, especially that it's in decline, right? And the stock market being the same thing, is it's like a stock picker's market, right? If you pick the right asset class right now, you could make a lot of money, right? It's figuring out what that is, right? Right. And given that greater than 50% of my business is from investors, it's important for me to be able to answer that question, right?
Very cool.
Yeah.
Very cool.
And what are a lot of these investment properties looking like?
The primary type of product, like I sell a very specific type of product. So that would be basically like a cash positive rental property located on a major arterial road within the suburban GTA. Okay. So, and the reason that is what I sell primarily is because as an investor, you can get residential credit, which you guys would know. So you can buy it as a house, right? You can earn a yield, so it'll pay for itself. It should, realistically, if your tenants are paying and if you buy well. Or it did do that in the beginning of COVID, at least, until prices kind of went insane. Ideally, a duplex and located on a main road. And the reason that you want it on a main road is because typically main roads are located within suburban secondary plans. So they have potential for being upzoned to a higher density designation. So you can develop them into multifamily projects, right? So, and that's not something that most of my investors do, but they hold it for 5-10 years, maybe 2 mortgage terms, and flip it out to a developer. And we
that knock one day.
Yeah, exactly. Well, and like I typically am the knock, right? Like, so I hold, like, I bring the primary investor in, and then eventually I'll help them flip it to a developer when the site's mature enough. So, and the idea would be, you put together 2 or 3 of these and you have a 1 acre land assembly, which is typically like the minimum that a developer will look at. And then you can, do a nice little 40, 50 unit infill project.
It's awesome.
Yeah, it's good stuff. There. Yeah, it is huge. It's good upside. I mean, it depends, right? Because you got to spend a lot, like, and it's not super meaningful. Like, it's going to cost you a minimum of $250,000 to get a zoning bylaw amendment to take that from what it is today to what you can do with it. So on a small site, it's not exceptionally worthwhile to spend all that money, especially for guys who are buying at their max buying power at 75% loan to value, right? To spend that
hard for them to carry,
right? But you get but you put together these little consortiums of investors where you have 3 guys and they can kind of all split it or whatever. Or you just start advancing the site slowly, take them to the pre-consultation meeting with the town, get some planners, some architects to start, doing some, not even massings, but just studies, figure out what you can build there. And then you kind of have a more compelling package to bring to a developer. Right. You say, answer some of the questions for them.
And you'll help navigate all
this? My brother's a landscape architect. So we kind of work together with that, like on that stuff. So, but the interesting part is like COVID kind of broke that model because, end users started outbidding my investors, right? So like the marginal buyer, one of us who wanted to live in a house was like, oh yeah, I'm gonna buy a duplex on like Woodbine or on like Steeles, like because they just needed a house to live in and there was no supply. And a lot of that, like that, can I swear? A lot of that shitty supply was like what was going out because it was investors offloading, being like, this is to the top. I've seen a couple market cycles like this.
I've seen a lot of upside.
And so, I like putting together land assemblies over the past 2 years has been like near impossible. So like that infill model kind of broke for me. I'm just starting to ramp it up again. I'm starting to get calls from investors again, a lot of opportunism in the market. Investors and developers are starting to pick up the phone again. But for the past 2 years, and that's sort of what made me kind of document, I was opportunistic myself, flipping over the content side to trying to attract end users as buyers, because I needed to make money too, right? We all have bills to pay. And I realized they were the ones that were paying the highest amount of money. So
nice. That's awesome, man. Very interesting.
Yeah.
This is not even about building the equity within that asset as you're making a yield through rent. It's the real long term and the big bucks at the finish line that you're working towards them with, right? Which is really cool. It's very unique. There's not a lot of realtors out there doing that, right?
Well, and I think a lot of it comes down to like most realtors are bulls, right? So like and you have to be in this business, right? But I'm not. Like I came out of the womb saying the market was going to crash, right? Like I predicted like 100 of the past 1 real estate declines, right? As they say for the bears, but and so that's one of the elements. Like in the past 2 months, I've actually been right for the first time in my life about what was happening with price. But so my thing was always like, I always wanted to mitigate downside risk, because when you see prices accelerating with the way that they were, I was like, shit, this is not sustainable. This is scary for investors. And I take the fiduciary duty that I have to clients seriously, right? So it's like, if I'm going to strap you to this investment, I want to make sure, 1, that it's yielding, and 2, that you can actually build in some real tangible value, not just, the market always goes up over time. Because I don't think the fundamentals of Canadian real estate are actually that good, or I actually think they're probably better as a result of supply chain disruption, cost escalation, immigration, et cetera, now than they have been. But 2 or 3 years ago, I was concerned about the prices. And so to me, that's the best way for an investor to actually have real tangible, equity multiple rather than, just hoping that the market goes up.
Yeah. Very interesting. Very
cool.
Thanks. Awesome.
Yeah.
Awesome.
So when you're talking about these assemblies and you're saying that there's that $250,000 is pretty much your startup cost for that. So what's that minimum assembly look like? You're saying like 1 acre or?
Yeah, I would say like you should target an acre probably. Okay. Like there depends on the municipality, right? But like let's use Georgina just because that's where I'm from and that's an area where I'm quite familiar with the secondary plan, right? So their secondary plan says that you need a minimum of 100-foot frontage. Well, it doesn't actually say that, but that's what they imply. So your average residential lot on a main road in that municipality, you'd need 2 of them at a minimum. But then it comes down to size, right? So there's a bunch of other different metrics. So they use units per net residential hectare there, or sorry, units per net residential acre. So if it's like 60 units per net residential acre, if you have an acre, you can get a 60 unit development, right? And then they have like lot coverage ratios, and I mean these are all things that I probably shouldn't be like making any real representations on, but I can speak generally about them. Like that's why we have somebody like I work closely with my brother because he can actually talk about the planning, the landscape architecture, etc.
Right.
But like they'll say, okay, if you buy a piece of land on this strip, then you can put 4 stories there. But if you buy it at this intersection, you can put 6 stories there. Like you've seen all this stuff, secondary plans, maps, etc. Right. So. It's just like it's a little bit out of scope for most agents. Like most of the guys at the commercial shops, like actually a guy you should probably have on here, Jeremiah Seamus from I think he's at Colliers. I don't want to misspeak actually. I think he's at Colliers. He's probably like the biggest guy, and he does like high rise sales. Super cool guy, and works with some of the biggest developers in the space. But like he'd be a guy who be a good example of someone who has like a really really good depth of knowledge with this stuff. So yeah, it's something I've been working on for a long time, and where I want to ultimately end up. But it takes time to build a book of business like that, especially when you're not doing it at a big shop like that.
Right. Yeah, absolutely.
Yeah. Very cool.
Absolutely. And for the investors that are looking to buy these properties within the GTA, Keswick area, what's that rental yield looking like right now?
I mean, you're kind of just getting like into the 5 cap territory again.
Okay.
Yeah.
Which is okay. Like you can, if you're buying, like if you're buying right, you're not pretending it's a primary residence or something like that, which a lot of people do. I don't encourage people to do that at all because it's like actual mortgage fraud, I think. But which is like, I don't know if that's a whole different discussion, but I mean, I think you're buying probably 70-75% loan to value.
Right.
So you should be cash positive at between a 5 and a 6 cap. That's a duplex though, right? If you're buying it, like I just sold one because it was a guy who was trying to do an assembly and just couldn't get the second site because it had gone up so much in value. Single family detached, little bungalow, $600,000. That'd be probably like in the 4 cap. But I mean, so that probably won't yield, but that's somebody who has a quicker exit. Like they're going to convert it to commercial, build a little 3-story building, right?
Yeah.
So your yield is usually like you want to. I typically wouldn't advise somebody unless they have like development experience or they're getting out of the deal quickly. I wouldn't advise anybody to buy cash negative ever, right? Like that's not my style.
Yeah. Sure. So take us through what that looks like from A to Z. So someone will come to you and say, okay, we want to take on an investment property, guide us through it.
Yeah.
What does that look like in regards to the initial cost? What does it look like in regards to rough timeline until completion when the project's developed and you could actually then come back in and flip it to a builder, someone else to do with it. And what that looks like on a profitability standpoint when it's all said and done. If all and I know it's a difficult question because of volatility, but if all the ducks align. Yeah,
if you were to say like in today's market, so like Q2 2022, you buy a site for like, let's say, you're probably getting in like the 5s, like 500 to 600 grand for like one of these, like that would be like a tear down, like, or you could probably yield it for like a little bit, but you'd be cash negative. But let's say you get 2 of those. So you're in like your land cost is maybe 1.2, 1.5 if you need it, like if you need 3 sites. But let's say for an acre, right? And then you get, let's just use a rough like $250,000. So like 250,000 for planning. That's just like application fees, architect, landscape architect, planner, etc. Like site, that's basically to get you to site plan approval.
Right.
You can, I think that's probably a little light just based on cost escalation, but let's just say, so, if we were say land at 1.5 5, you're at 1.75, let's say now, just shy. You'd probably be creeping up on 2 million before you have site plan approval, and then you'd probably I don't know if you reduce that to a buildable square feet. I'm trying to think now, like a site I did recently, it's going to give you about like 150,000 GFA. So I don't know what that is at, like, you'd probably be selling, if it's site plan approved, you're probably selling it like in that market in Georgina, like $40 to $50 a buildable, I'm going to say. So I don't know, what's that, like $4 or $5 million, right? So it's not bad. Because yeah.
And then around 2.5, and then 4 or 5 mil. So
if you're in for 2, but that's going to take you probably, I mean, in a municipality like that, if you even get it, you're going to be 5 years, I say, so like a full mortgage term probably.
Okay, that's okay.
So, no, it isn't, right? But it's not as lucrative. Like, I mean, so what's your return if you cut that up over a couple of years? I mean, I'm gonna get roasted for doing this math like verbally in my head, but it's like, I know you're maybe get like an IRR of like 20 to 30%, right? Like your internal rate of return, I think.
If you're on about a mil 2 hard cost, right? Given the down payment and everything else, and you're looking at a 20%. 25% yield a year, right? Yeah. You're at around 1.2, maybe around 30, 35, 40 if you're really good.
If you get it done quicker, right? It's cutting 40. It down if you want. Yeah. Like most of these guys think about it.
Which is good. Like even with our investors in the private market, like we're offering them 8-9% on a first mortgage annually, plus a point for the fee. So and they're happy with a 9-10% yield. So I mean, anytime you're talking 25 to potentially 35, 40, that's good, man.
It is more hands-on though. Like I would say developing is a full-time job. Even if you're like, it's definitely like what you're describing would be, that's probably the only way to make passive income in real estate, I think, right? No doubt. People think like landlording is passive income. It's like no, that's a relationship business.
There's a few moving parts with that one.
Yeah, for sure.
I think like you said, that's your only passive income with you're completely hands off. Here's the check. We know when it's up for renewal. We'll figure out where to put it next, and that's it.
For sure. For sure. Cool. Yeah, I mean, even guys who are doing equity, like or mezz guys, like that's still pretty active, like capital, right? Like I think privates are like really one of the only things, and probably the lower risk side too, right? Like there's minimal stress unless like the market we're in right now. If you're a 90 or 100% loan to value guy, you might be having a bad day. But I don't know. You don't strike me as the type to be putting guys in those.
No. Right? We've been telling our lenders most recently we don't want to take it past the 65, 70 LTV. And we're coming closer into the GTA now just because of the volatility, and it's like for an extra point or two, like why take the risk kind of thing, right? So
and it is interesting to see like the more rural markets like haven't even recoiled as much as the GTA yet so far. Like the GTA actually was really responsive to rate hikes. Like prices came down fast, right? Stouffville's like 30% off peak, it's like 37% from February to present day, minus 30%, right? Georgina's like down 26, like depending on what metrics you use, right? But but you go up, like I do a lot of acquisition up in like French River area. And we have a place up there, and the realtor who we bought it off is like, we can flip this thing for like twice what you guys paid for it. Like this is like beginning of last year. And I was like, no, the market's gonna like eat shit. Like there's no way. Like we'll just rent it out, right? And then she's like, no, I can probably get you more than I said like 2 weeks ago. I'm like, what the hell is going on? But then a couple of days ago, she's like, how'd you know the market was gonna go down? I'm like, well, I don't know, like read the news. Have you been to the bank recently? It's gonna cost you a lot more. So I don't know. The resilience of those rural markets has been interesting to me. That's really fascinating, right? Like Sudbury, Kirkland Lake, a lot of those like municipalities that have exposure to precious metals and stuff, because the government's really ramping up like those areas. So from an investment perspective, that's where I'm putting my money for sure.
Very cool.
Because I even noticed towards the end of the hike in pricing was people were starting to reach out to the Sudbury, North Bay areas, whereas that was like right towards, let's say, beginning of 2022. I was noticing some clients coming in with that. It
makes me wonder like whether or not those markets are actually like their price floor is actually established by replacement cost, right? Like when you guys look at an appraisal, they have replacement cost new, right? So the banks use that as at least a third of the valuation that they're appraising properties on. And appraisals are typically more accurate in rural markets than they are in urban markets, right? Like, and same with MPAC valuations. If you look at like Sudbury being a good example, right? Like until mid last year, you could buy any house you were buying in Sudbury, you couldn't rebuild the house for the same price that you're paying for it. So you're functionally buying something at negative land cost, right? Now we're a little bit above that, but like I can't see, as long as they're still building houses in Sudbury, which I don't like see why they wouldn't, because Canada's growing. I actually think those markets are a little bit more insulated. The suburban GTA is really where the pain is going to be, right? Like you're already seeing it. The prices, like they were trading at 2x replacement cost, right? And so that's, you know,
good point too on in regards to the cost of the building and the value of these properties, right? And what that looks like if you were going to tear something down and put up a new structure, and how it just doesn't make sense, right? So because if even if you're building in an outside market, it's still the same cost. Sometimes even more.
Yeah, sometimes they can be a little bit cheaper, right? Like your hard cost, like lumber is, you know, pretty much. I mean, like you could argue, if you really get granular, like lumber's a little bit cheaper in Sudbury because you're closer to the mills, right? And a lot of it comes out of the forests up there. Trades, like, you know, because the guys don't have the cost of living in the city, you can save a little bit on trades. But like, maybe it's, I don't know, a 30% cost saving. You're still building at like $250, $300 a buildable square foot for detached up there, right? It's not like it's, you know, you build a 2,000 square foot 4-bedroom home, you're $500,000, right? Like you can buy a house in Sudbury for less than that right now, right? So
a lot of the guys here that know what they're doing. We had a couple boys on the podcast that run a pretty good show. They're just pricing sometimes a little bit, you know, above and beyond what it's standard to build, because they know they're good and they know there's a huge demand, and it's hard to get good guys out. Just having a contractor being able to come in and get the job done is a challenge, right? And these guys are pricing for it now.
They might as well, right? Like I think that's capitalism. Like if you're oversubscribed, right? Like it's like the real estate market. Like everybody wants to be like, and it's like you look at developer profits too, right? Like everyone's like, oh, developers are so greedy, that's why house prices are going up. Like, you know, at the end of the day, like the municipal government makes more money on a unit than the developer does, right? Like from development charges. Like if you're charging $90,000, $100,000 on it per unit, like that's, you know, like in Toronto condo, if they're selling it at $700,000, like it's like over it's like
crazy.
That's what the municipality is making. So and you know, and they're trying to increase that. Like they just increased development charges like 4 years ago by 110%. Now they're trying to increase them again by 45%. Like it's ridiculous, right? Like it's crazy. Wow. So everybody, but you know, like everybody wants, and even the municipal government, they're like, oh, developers are so greedy. Like, we just need them to like, it's like, oh you know, like, I'm an asshole. Like as opposed to everybody else who goes out and does their job for free every day, right? Like, So I mean, they're not making a ton of money. Like, margins are tight, right? So
they are.
And if you're oversubscribed, like why not charge more? That's like that's how you grow a business. It's like my brother's like this. He's like I have too many clients. I'm like, okay, well then start charging them more. Watch whichever one disappears doesn't care. Like you know what I mean?
Absolutely.
I love that take, and the way you just break it down and made it so simple. There, it's so true. Just up your prices, right?
Know your value, know what your worth is. Why you spread thin and give less desirable quality of work rather than you want me. This is what's going to cost.
For sure.
And then to go to Daniel's point, if they don't value that,
exactly,
you're not going to service them. You don't really want to service them anyway. Anyway.
For sure.
But very, very interesting.
Thank you so much for coming out.
Thanks for having me.
And let everybody know where they could check you out.
So Daniel Foch, most easily found on Instagram probably, which is at Daniel Foch.
Yeah, awesome. Be sure to check him out. And thank you again for tuning to this week's episode. Be sure to like, follow, and share. Hit that subscribe button below, and we'll see you next week.
And big shout out to our sponsor, CB Wine Program. Subscribe, cbwineprogram.com. They're awesome. They got exclusive drops that you can't get in the LCBO, and you can only get them if you're a subscriber. So definitely make sure to check them out, and thank you very much for the sponsorship. Next on What Would It Cost?
I think that as a new agent, it's so important to, I guess, you know, build that experience, and building that experience comes with time. And I think that by joining a team, you're just fast forwarding that. You're just like expediting the whole process, because like you said, you're just surrounded by powerhouses who've been in the industry. They have the experience and they can show you the ropes no matter what the situation is.
Absolutely. Good on you for recognizing that though.
Thank you. Yeah, for sure.
Plugging into that, because these are habits now that you're going to form that are going to stick with you for your whole career, and you're going to be an absolute beast.
Get the real experience. Work the 80 hours a week. Talk to 100 people a day. Meet a bunch of people. Do the work. Meet clients. And when you're working with clients, do the most for them.